Hi there, I'm Tyler Ballhorn, and this is the Stock Scores Market Minutes for November 1st, 2013. This week I want to talk about the emotional attachment to money and how it is the enemy of every trader. If you can't sleep well on your trades, whether you are a long-term investor or a short-term trader, then you are likely to make bad decisions with those trades simply because you have become emotional about the positions that you hold. You will be a better trader if you can minimize your emotion and really minimize that emotional attachment to your money. Now, how do you do this? Well, there's a few different things to think about. First, what is your risk tolerance? How much money are you willing to lose on any one trade? And if you take more than that amount of risk on a trade, then you are likely to break your rules. Now, I've said it many times, you should not let small losses grow into big losses. If a stock hits your exit point, that point where you decide that it is best to take a loss, then you should exit. The problem is if you've taken too much risk, then when you get to that exit point, you look at the potential loss at that point and you say, well, I don't want to take that big of a loss, it's too painful, and so you choose instead to hold on to that position. Well, that has dire consequences because that is when the small loss grows into a big loss. So in choosing position size, one of the helpful tools that we offer is the Stock Scores Risk Calculator. This allows you to enter in your risk tolerance, your entry price, and your stop loss price so you can determine what your total risk should be or what your total position size should be. I'm over in Stock Scores now, and we're going to use that tool very quickly. I go to Tools, select Risk Calculator, and here I can enter in my position entry price. Let's say I want to buy the stock at $10 with a stop loss at $9.40. And of course, these prices are based on what you actually see in the market. Your stop loss price should be based on support on the chart. Now, if you didn't want to lose more than 1% of your $50,000 portfolio, and you pay $10 in commissions round trip, click on Submit, it will tell you that your position size can be the number of shares that it is. In this case, that's 817 shares, which we round down to 800 shares, and basically this tool is helping you decide what your position size should be. 800 shares at $10 or an $8,000 position will expose you to that $500 risk tolerance, which is 1% of your portfolio. Now you can enter the values in here however you like, but it's a quick and easy way to figure out what the total position size should be based on your risk tolerance. Now the second bit of advice that I have is to monitor your stocks, but don't watch them too closely. The stock market can mesmerize you into getting emotional by watching the little up and down swings in a share's performance. If you are a position trader and really trading off of the daily chart, then looking at your stocks throughout the day is probably going to heighten your emotions more than is helpful. If I'm position trading, I really only look at those positions in the evenings or even just once a week. And at that point, if the stock closes below my exit point, my stop loss point, then I exit. But otherwise, I don't worry too much about the little gyrations that I see intraday. It's helpful to use the Stock Scores Watch List Creator where you can build a list of your positions. So we can go into the Watch List Creator and create a watch list called My Positions and then enter in all your stocks. So you might own Suncor, Apple, and IBM, and maybe Tesla, and maybe, I don't know, doesn't matter, T.SKS. I don't even know if that's a stock. So you enter all those in, and then you go through the watch list creator, and once you've done that, you've created a list of stocks that you can then view with one of the chart viewers. So if I go into the gallery chart viewer, I can go into my watch lists and take a look at any of the watch lists that I've created very quickly and see all the individual charts of those stocks so that I can quickly determine if I should be selling any of them. It's an easy way to monitor your stocks. It's a free tool to use on Stock Scores, and I think it will have some benefit to controlling your emotions. Finally, have a written trading plan. And I say written because if you simply have some idea in your head about what you want to do for when you're going to buy, when you're going to sell, it's likely that you will not follow through with that if it's not written down. Trading plans should be one page. When am I going to buy? When am I going to sell? How am I going to manage risk? And it doesn't matter whether you are a short-term day trader or a very long-term investor playing conservative dividend-paying stocks. Take the time to write down a one-page plan for what you're going to do with your money. And that plan should be based on sound trading theory. Don't gamble. Don't say I'm going to buy stocks because I saw someone tell me that it was a good stock. I mean, you have to have a plan that is well thought out, that is based on some testing, some sound ideas, whatever those may be. Whether you choose to follow my strategies, your own strategies, someone else's strategies, doesn't matter. What you want is a plan that is well thought out. You don't want to be a gambler in the market. All right, so let's get into this week's analysis. The S&P 500 continues to be pretty strong right up at the top of its upward sloping channel, and it's actually broken through the top of that channel, and that tells me that we may go now into a steeper upward trend. I'm still pretty cautious about the market simply because I don't see that buyer enthusiasm that we should see. You know, the market's been strong, but there's not a lot of enthusiasm among the buyers. You see institutional money taking positions in the morning on stocks that have good earnings, for example, but then the stocks go sideways all day. There's no follow through. There's no real bullish sentiment among longer term investors. Now, if we look at the longer term chart of the S&P 500, and this is a 3-year weekly chart now, you can see that in the big picture, we do have some room to the upside in that longer term upward sloping channel. So if we do get a sound break from the existing channel, this one, and which it seems like we're trying to do, then we could rally up to the top of this longer term 3-year channel. I'm not 100% on whether that's going to happen simply because I do see that lack of enthusiasm. All right, the TSX 60 continues to do very well. A little bit of profit taking late this week, but the bank stocks in Canada continue to be the outperformers, with energy, which we've talked about a number of times in recent weeks, also doing well. And I think you have to continue to be a bull here. We've just gone to a bullish stance on the TSX. I do think we could see a little bit more of a short-term pullback, but the longer-term picture remains strong for the TSX. This is a chart of the 20-year bonds, and it is still trying to build some optimism. Had some weakness right at the end of this week, and that is a little bit of a negative for the stock market because, of course, if the price of bonds goes down, that means yields go up, interest rates go up, and that's a negative for the market. But in the big picture, this bond market here is trying to turn around, and until that cycle of rising bottoms, which I've identified with the green line, is broken, we shouldn't be too worried about it. The Chinese market broke its upward trend line last week. It's bounced back very nicely, and so I now think we're in sort of a pause that refreshes type approach to the Chinese market right now. It's building this flag pattern, which I've identified in red. And what that means is the market was building optimism through the summer. July, August, September were good months for the Chinese stock market, even the first half of October. And now we're just in this pause phase as you get some profit taking, some second guessing of whether the strength is valid. If we can break through the top of this little flag pattern, that top red line there, then it should continue its upward trend, and that will be a positive for global markets. All right, emerging markets, kind of a similar situation. It's trying to break that downward trend line. It's actually done that, but it's not got the kind of commitment that we'd like to see. The buyers were strong earlier in October. Now they're second guessing it. It's a situation where it's going to take time to build momentum, and that's the case with all upward trends. It takes time early in the trend to build that upward momentum, and I think that we're just seeing that play out. I believe that as we go into 2014, you're going to see momentum slowly building in the emerging markets, in really the global economy, as it plays catch up with the US. One of the reasons for some weakness in just about everything last week in terms of the US stock market and some of the commodity prices, gold had a little bit of a weak end to the week, was the strength in the US dollar. You can see here the US dollar was pretty oversold. We talked about that last week and due for a bounce back. It has made a very good bounce back. It's now up to its downward trend line, and so we should see it next week kind of fizzle out in terms of this strength in the US dollar. Now, should doesn't mean it will. It just means that, the last 5 days of strength are going to meet some selling pressure in the near term. So this is an important chart to watch because it affects so many things. It affects commodity prices, it affects stock prices, bond prices. They're all related to the strength in the US dollar. And this strength that we saw is a little bit of a surprise, I would say, but it hasn't broken the bearish sentiment in the US dollar yet. So keep an eye on that. The fact that this is strengthening tells us that the market doesn't expect tapering, or does expect tapering to start soon. And that's a reason why there's some strength in the US dollar. As I've been talking about some time now, gold is trying to break its downward trend line. Every time it gets up to that downward trend line, it seems to get stuck. And so we've seen that again this week. It rose up to that downward trend line, and then perhaps the strength in the US dollar helped it get stuck. But until it can break that downward trend line, I don't want to get too optimistic on gold. I think that you can start to nibble at this sector on speculation that it will break the downward trend line because we do have those rising bottoms building. But I wouldn't be at all optimistic until that red downward trend line can be broken. That's the cycle of pessimism that has existed in gold for some time. Here's the chart of oil, and it's a little bit surprising the relationship here between oil and energy stocks, because energy stocks have been doing quite well, but yet you can see here that oil prices over the last 2 months have been doing pretty poorly. We've actually seen some accelerated selling to the downside on oil this week. It's taking it down and away from that downward trend line. So I think oil is a little bit oversold here. It's all related to this notion that things are better in Iran and things will get straightened out, which affects the whole Middle Eastern issue, of course. But I do think that in the short term, we could see a little bit of a bounce back in oil, but you got to recognize that the chart here is somewhat pessimistic for oil in the near term. Now, that's a pretty short-term picture. When you look at the longer-term picture of this chart over the last year, really we've got a sideways oil market, even a little bit of optimism in that oil market. So perhaps that's why oil stocks are still doing okay. The fear index, the VIX, is dead. Nobody is too fearful of this market, which is a bit of a concern. That complacency can come back and haunt investors, but for right now, we don't see any sign that investors are real worried. So my comments here, really nothing different from last week. It's bullish on US stocks, but I'm cautious there. Bullish on Canadian stocks. I think there's going to be a pullback. Gold, I'm neutral. I'd like to see that break the downward trend line, but I have to recognize that that bearish trend still does exist. Oil, neutral. Big picture, it's a sideways market. Short term, there's some bearishness there, but a little bit oversold. So I do think we'll see a bounce back in the near term. Well, that has been the Stock Scorers Market Minutes for November 1st, 2013. Have a great week in the market.